Welcome to StraddleIncome. In today's video, let's talk about the stock market. The last couple of days has definitely been a very interesting ride for a lot of people. The market dropped significantly in the last couple of days, and a lot of people's account has been hit. This goes the same with one of the StraddleIncome's account. The account which you're seeing right now is belong to one of the StraddleIncome's, a member. And the account actually previously, a couple of days ago, it was sitting at $48,000. And in 2 days, it dropped from $48,000 to $44,000. At the end of the February 18, when market closed, the account is sitting at $44,000. And today you can see the net change is $1,600. This is quite significant, and the rate of dropping is very, very strong. So this comes back to the question, are we at the end of the market run? Are we officially in the market correction zone? Is market crash coming to us? We believe at StraddleIncome, we believe this is a rotation. The hypothesis is that market is rotating away from high growth oriented stocks to value-based oriented stocks. Let's look at the indexes to help us understand why this hypothesis could be valid. What you're seeing here are two different charts. One is for the S&P 500, and it's a daily chart. The second chart is the QQQ, the technology-oriented, the growth-oriented indexes. The blue line is the 18-day moving average, and the yellow line is 50-day moving average. And as you can see, the last couple of days, the market has definitely slowed down the way it goes up for both the S&P 500 as well as for the high growth oriented QQQ indexes. And for QQQ, it's actually coming and touching the 18-day moving average. But for SPY, it's still quite sitting above the 18-day moving average. This is telling us that QQQ, the index, which is mostly focusing on high growth oriented stocks, they've been impacted more than other stocks in the S&P 500 indexes. So the QQQ, because it's more impacted, it comes down, dropped faster than other indexes. So right now it's at 18-day moving average. But it's still very, very healthy. And you can see that SPY is still quite above the 18-day moving average. And let's look at this IWM, which is the Russell 2000 indexes, the small middle cap 2000 companies that this index is tracking. This index is starting from the beginning of January as being on a tier, just kept going up. And then recently it kind of just slowed down, and in the last couple of days, it's getting closer to the 18-day moving average. But this is still well above the first support line, 18-day moving average. So coming back to the QQQ, if you look at this chart and then if you zoom out, this has just been continuously running up after the election. It's coming back to the 18-day moving average, quickly rebounded, coming back to the 18-day moving average towards the middle of the December, quickly rebounded. And then the next significant drop is the end of the January, actually pierced through the 18-day moving average, but still sitting well above the 50-day moving average, and then quickly rebounded. So this is very, very healthy. The market needs to pull back in order to move higher. And with that evidence supporting our hypothesis that the entire market is rotating away from high growth oriented stocks to value-based stocks. And the potential reasons that could driving this kind of rotation. We believe there are two things. One, the earning seasons, and then number two, it's the fact that there's no more policy boost coming from the government. For the earning season, we're still in the middle towards the end of the Q4 reporting for 2020. But a lot of the well-known companies in the spotlights, they have reported earnings. Apple, Tesla, Netflix, Disney, TSM, Qualcomm. Those stocks that are being on the TVs, being on people's attention, they have all been reported. And without those kind of things driving the market is getting less and less excited about the entire, the future trajectory of the entire stock market. Still, given the fact that we have a lot of other small companies to be reported, but the biggest companies have all been reported, and the results looks good, but however, the market has really been in a tear up kind of earning run-up zone in the last couple weeks. It really started from the Netflix reporting. It just kept going up and up. People are more hyped about the potential earnings. And now all the bigger cap companies have reported earnings. A lot of the people, the hot money, are kind of just taking a break. This is the first reason contributing to this rotation. At least that's what we believe. The second is because the stimulus. The stimulus, the government boost, it's being concluded, and the market has priced it in. So in the next couple of months, at least at this point, there's no significant news that there's going to be new physical boost. So the market is, priced it in and finally decided to take a break because there's just nothing can come into the market and pump the market up. Now, with that being in mind, this is really what we're thinking here at this point. The entire stock market is very healthy. And to support that, we actually made a couple purchases in the last couple of days. You can see this is the transaction record from the StraddleIncome account. In the last 2 days, actually, let's start from today. Today, we bought 20 shares of a PLTR. The PLTR is, coming back from $37 to $25. This is a very good price, we believe, and we decided to add more shares. Additionally, we added a couple more calls for Walmart. Unfortunately, the Walmart reported earnings today, and it's not that good. But we were still very positive before the earning reports. Secondly, we also bought 5 shares of Apple, the Apple shares, and that was yesterday when the market first started to pull back. The Apple was hitting, and it dropped from 135 to 129, and this is a good price, and we bought a couple shares of Apple. Further, we opened a bull put spread, which is bullish about the ROKU stock. The ROKU is reporting earnings today, Thursday, and we're still bullish about the ROKU account, especially given the fact that all the streaming providers have been in a good run in the last couple of weeks, starting from Netflix, Disney, and other companies. So we were bullish. So what I'm trying to say here is that there's nothing more evident than our own actions. And our own action is to get into this market where I think some of the good stocks are coming back a little bit. So it's a good time to actually buy some stocks. So-called buy the dip. However, we should still be very, very careful here. If the market actually starts piercing through the 18-day moving average, and even worse, the 50-day moving average, you should have a game plan. Figure out where is your exit strategies, just so that you can plan ahead, and in case it hits, you will not be panicked. So Here's everything about the market in the last couple of days, and I hope the information I'm sharing here is useful, helpful. If so, please make sure to subscribe, click the like button, and share with your friends. We really appreciate your time, and trade safe. Make sure you have a game plan, and I'll see you in the next video.